In this video, we're gonna have a quick look over at the train company of Norfolk Southern. I think probably one of the more famous train companies as of late, because of course of the train derailment that happened in February 3rd, 2023, when one of the trains of Norfolk Southern derailed in East Palestine, Ohio, carrying hazardous materials. There was a lot of bad press concerning Norfolk Southern because they have been neglecting some of their safety features, some of their additional costs required to keep their operation successful and also safe. So let's have a quick look over at their financials and see what's been going on with Norfolk Southern here for the past 10 years. Let's see whether or not we think it's a good business, and let's see whether or not we want to invest in it for the next 10 years. So when we look over at their revenue, we can see that their revenue is very much stagnant here for the past 10 years, an overall increase of 1.3%, which is even underperforming inflation. So Norfolk Southern is very much trying to optimize their operations and not so much trying to expand, which is a trend that we see with most of the train operators in the United States. Most of them are focusing on cost reduction and efficiency, and they try to create value for shareholders by doing share buybacks. So this is also what we see here for Norfolk Southern. Their revenue is very stagnant for the past 10 years. Their EBITDA is growing by about 3 to 4% every single year. So this is what I meant with they're trying to make their operations more efficient. Their debt level is growing in line with their EBITDA numbers, which is not a bad thing per se. Excess cash on hand. Usually they don't really have much excess cash on hand, and just looking at their debt level, we can also see that it's kind of in the 3 times ratio already. So I actually don't think they can borrow a lot more money to create the excess cash war chest that many companies sometimes have. Their market cap has been increasing by 7% annually. Enterprise value, so this includes the market cap to which we then add the debt and we subtract the cash, has been increasing by 6.8%. EV/EBITDA ratio, historically their EV/EBITDA ratio is around 12 times. Their net debt to EBITDA ratio is always approaching around the 3 times ratio, which does mean that Norfolk Southern is completely leveraged and there's not much more wiggle room for them to acquire additional debt unless they increase their earnings. So let's quickly have a look over at their cash flow now. So cash flow from operation has been increasing by 3% annually in line with EBITDA here. Their capital expenditure, however, and this is where we get to the crux of the matter, I do believe, has been decreasing by 1% annually. Capital expenditure includes all the future-proofing methods for Norfolk Southern to keep on operating their business in the future. We're talking about maintenance for rails, maintenance for their cargo, maintenance for their locomotives, any additional cars, any additional coats of paint, any additional safety measures that needs to be included to keep making sure that the operation is running as safely as possible. And so the expenses paid for this has been decreasing by 1%, even though they have been running the same operation, which does show that they've been reducing their maintenance costs here for the past 10 years in the name of efficiency. And even though this does mean that the amount of free cash flow that's available for you as an equity owner is increasing because of this, it also shows that there is more safety problems that might occur because of the lower capital available for maintenance. And this is also probably, well, not the reason of course, but probably one of the underlying facets that's responsible for why the Ohio train derailment actually happened, because we do see that Norfolk Southern has less money available for maintenance and making sure that everything runs properly. Their free cash flow therefore has been increasing by 7% annually because their cash flow from operation has been growing and their capital expenditure has been decreasing. So this makes for a hockey stick curve for their free cash flow. They've also been steadily reducing their share count by 3% annually, starting with 316 million shares in 2013 and 236 million shares in 2022. They basically bought back 80 million shares in 10-year time frame and just ripped them up in your favor, very much increasing the free cash flow per share, as we can see here in the next table. 11% increase in free cash flow per share because their free cash flow is increasing because they are reducing costs for capital expenditure and they're buying back a lot of shares with the free cash flow that they do have. So this is why we see such a massive increase in free cash flow per share, even though their earnings are not growing, right? The free cash flow per share is mainly growing because they've been buying back so many shares. Price per share on average has been increasing by 10% for the last 10 years, about in line with market expectation, maybe slightly outperforming it. I think overall the price on the open market for any company in the S&P 500 is around 7 to 8%. Norfolk Southern is 10% because of course most of their free cash flow actually goes into trying to appreciate their share price in the way of share buybacks. Free cash flow yield on average around 4%. So now we're getting into the business of trying to forecast Norfolk Southern here into the future. So looking at that EBITDA, we can see that it has been growing by about 3 to 4% here for the past 10 years. So I'm going to give them 3% here for the next 5 years because I do expect that they have to do some additional capital expenditures here in the future because of the derailment. There was a lot of backlash, a lot of political backlash as well, and they came to an agreement where railroad companies have to put more money towards their employees and towards the safety of their employees. So I think this will increase the cost of capital expenditure, therefore decreasing their free cash flow and possibly also decreasing their EBITDA. So I'm going to give them 3% for the first 5 years and then reduce it to 2% for the last 5 years, basically saying the operation will grow in line with inflation and nothing more. I'm also going to attach the 12 times multiple as we have seen from them historically, and this gives me a share price 10 years from now of $295.63. And I'm going to do a very similar thing here for their free cash flow method. I'm going to give them a growth of 5%, even though historically they've been doing 7%. I do think also for the same reason, because they have to increase the cost for their personnel and increase the cost for their capital expenditure and maintenance, I do expect this number to come down a little bit. And even if it doesn't, I do like to have this additional level of conservatism baked into my projections. So I'm going to give them 5% here annually for the first 5 years and then 4% for the last 5 years. I'm also going to attach the 10-year average free cash flow yield of 4%, which then gives me a stock price in 2032 of $417.31. Right now on the open market, I can buy as many shares of Norfolk Southern as I want for $230, which has come down quite a bit already from their $300 price here in 2021. It was reduced to 247 here in 2022, and it's been reduced even more right now in 2023. Mostly, of course, because of the train derailment, but also because I think Norfolk Southern was simply a bit overpriced back in 2021, 2022. So combining my two projections here of the enterprise value as well as the free cash flow model, I expect a share price 10 years from now of $356.47. Simply looking at the share price on the stock market alone, I expect a compounding annual growth rate of 4.5%. But the moment that we include the free cash flow per share that we have projected here in our free cash flow model, I expect an IRR, an internal rate of return of about 10.8%, around 10%, which I think is in line with the overall market expectations. I always say on average the stock market returns about 10%, so I think that Norfolk Southern will very much perform in line with the overall market expectations. So let's see what happens if the price goes up or comes down a little bit. So the moment that the price goes down by 30% to $165, I expect an IRR of 16.3%, which is quite attractive, I think, for a stable company like Norfolk Southern, which has a very wide moat, as they say in the financial world, which basically means that the risk of competition is very, very low. Because if you want to compete here with Norfolk Southern, you're going to have to place an entire railroad right next to theirs, which is a lot of upfront cost, which is basically not worth it if you have to then share the revenue with Norfolk Southern. So they have a very established business with a low risk of competition, which directly translates to a wide moat. So the moment I can get Norfolk Southern for about $165 a share, I will definitely be interested and have a look over at their 10K. But I think for now, for $230, I'm not that interested. And the moment that the price goes up again to about the $300 range, which we did see in 2021, I expect an IRR of around 7%, which is underperforming the market overall, and I definitely think it's way beyond what I find to be an attractive valuation for any kind of stock. So this was Norfolk Southern in a nutshell. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff, and I'll see you in the next one. Cheerio!